All the attention is on the US Fed this week as we enter into what potentially might be the first tightening since 2006 with the FOMC meeting on September 16-17. I want to turn the attention first to the labour market indicators that the Fed will be considering in the decision process. We can see here these are labour market indicators. Down the left-hand side, we've got a range of different indicators. On the top of the graphic, we can see weak through to strong. The purple bar or triangle represents the most recent reading, and the grey one is what the value of that indicator was 3 months ago. So you can see here, just eyeballing, we've got payrolls, layoffs, job openings, the Conference Board Consumer Confidence Index, the unemployment rate. All these are towards the strong end. If we click on just to one of these, we can see job openings have moved to their highest level really since 2000. We can also see that layoffs are down towards the bottom end of the range that we've seen also since 2000. So some of those indicators are very strong, and of course the unemployment rate itself falling to 5.1. The Fed itself has suggested that full employment is somewhere between 5 and 5.2. So for all intents and purposes, the US is at full employment. Although when one considers measures such as underemployment, we would suggest that they are not near full employment. But having said that, the underemployment rate has also fallen below its longer term average and now sits around about just under 10.5%. So on balance, these indicators would suggest that a potential tightening is certainly on the cards, although when we look at some of the indicators that are not that strong at the moment, the obvious one really is the hourly earnings. And we look at that and we can see hourly earnings are running at around about 2%. So despite what some might call a tighter labour market, the growth in wages remains very, very low at the present time. The other component of the Fed's mandate, of course, is inflation. And if we look at a range of different inflation measures, gold line I'm showing the core PCE price index, which tends to be the preferred measure, and that's running at around about 1.2, 1.3 at the present time. The Dallas Fed also has some trimmed mean inflation numbers using 6 months of data and also 12 months of data. The 12-month number, the red line, is running at around about 1.7, but interestingly, the 6-month annualized number, the purple line, is pushed up from about 1.2 to close to 2%. And it might be that has been giving the Fed some confidence that inflation over the medium term is likely to rise to 2%, in which case it would be in line with target and would call for Fed action. Quite a disparity between the two measures at the moment. There are other factors that the Fed is likely to consider in its monetary policy settings next week. One, of course, is to look at broader monetary conditions, and we have a relatively simple measure that incorporates both the real level of cash rates but also the real effective exchange rate. So if we consider this, then we can see that monetary conditions have actually tightened, certainly over the past 12 months, with the currency rising by somewhere around about 15%. So perhaps financial conditions are certainly not as easy as they were back in 2012-13 and have actually already tightened up given the rise in the currency that we have seen already. Another perhaps broader measure of financial conditions for the US is produced by the Chicago Fed, and it incorporates sub-indicators for leverage, risk and credit. And that's the red line, and that's been tightening up also since the mid part of 2014 and is almost to its highest levels since the financial crisis. So it would appear that financial conditions and our simple monetary conditions index have been tightening, largely by virtue of the currency strengthening, but also by a rise in corporate spreads that has occurred over the past 6 months. And certainly when we look at a range of sentiment indicators in the US equity market, we can see that investors have already priced in some of these tighter financial conditions. Just have a look at a few of these indicators. Clearly, technical indicators like relative strength index have fallen down towards the low end band with a reading of around about 30. We can also see that the put-call ratio has also risen. Bottom left-hand chart, it's risen to its highest level since 2012, and the a bull-bear spread index has also fallen to probably its lowest level since 2013. So all these indicators obviously already suggesting that a fair bit has been priced in to the market. Our take on the Fed is that they are likely to sit on hold in next week, but a tightening still looks likely by the end of the year. Basically, the labour market indicators would broadly support at least a move towards normalisation, but the inflation indicators are still some way off, and we'll get some more clarity on that, we believe, over the next 2 to 3 months.